Private credit was supposed to be the safer alternative, flexible, modern, and outside the traditional banking system. But over the past few months, we've seen bankruptcies in the United States, a lender collapse in the United Kingdom, funding pulled from finance platforms, funds restricting withdrawals, and now record redemption requests from one of the largest private credit funds in the world. So something is clearly shifting. The real question is, are we seeing isolated stress, or are we watching the cracks start to spread? Hi everyone, welcome back to the channel. In today's video, I want to provide you with an update onto what's happening in the private credit market, because the frequency of negative developments is increasing, and when issues begin to appear this regularly in credit markets, it's usually worth paying attention. So what is private credit? Well, private credit is lending outside of the traditional banking system. Instead of banks providing loans, asset managers and private debt funds step in. They raise money from pension funds, insurance companies, sovereign wealth funds, and increasingly high net worth retail investors. And they lend it directly to mid-sized businesses, private equity-backed firms, property developers, and specialist finance companies. Now, for years, this has worked very well. Higher interest rates meant attractive returns, banks pulled back after 2008, and the private credit was filled this gap. But here's the point. The risk didn't disappear, it migrated. So how big is this? This is now a market measured somewhere between 1.2 and 1.8 trillion dollars globally. This isn't a niche. This is now a major component of global corporate lending. And when a market of that size starts to wobble, even slightly, it matters. So let's talk about Blackstone. The most recent development here is that Blackstone, which is one of the largest credit funds in the world, BCRED, with roughly $82 billion in assets. Now, normally investors are allowed to redeem up to 5% per quarter. So if you've invested into the fund, you could get back 5% of that every quarter. But early in 2026, investors asked to redeem 7.9%, roughly $3.7 billion. That is a record request. Now, Blackstone responded by increasing the redemption cap and injecting $400 million of its own capital. So it's not a collapse, but it is a signal. When investors rush for liquidity in record amounts, confidence is shifting, and confidence is everything in credit markets. Then we have Blue Owl Capital, a roughly $300 billion asset manager heavily involved in direct lending. They lend to US-sized mid-corporates, private equity-backed firms, software, healthcare, and industrial businesses. And one of their retail-focused funds hit withdrawal limits. They restricted the redemptions and sold around $1.4 billion worth of loans to generate liquidity at around about 99.7 cents on the dollar. So not catastrophic. So what that meant is that basically they sold the loans at below par. But this is a liquidity pressure issue. Tricolor Holdings is a US-based subprime auto lender. It sold used cars and financed customers with weaker credit. Those loans were bundled into securities and sold on. When defaults began rising, warehouse lenders pulled their funding, and that was it. No funding, no business. Bankruptcy followed in 2025. So this wasn't depositors panicking, this was funding evaporating for that business. First Brands Group is an American auto parts manufacturer, a real economy business. It accumulated roughly $11.6 billion in liabilities, layered financing structures, receivables funding, private credit exposure. When scrutiny increased, confidence dropped, the company filed for bankruptcy. And this was a borrower failure driven by leverage and complexity. Nobody really understood what was going on with all of that debt. And we talk about MFS, Market Financial Solutions, which was a London-based property bridging lender. The loan book peaked at around £2.4 billion. In February 2026, it entered administration. So basically, it's now illiquid and filing for bankruptcy. So questions emerged about collateral structures, and headlines quickly appeared about exposure at major institutions. Stress doesn't stay contained for long. It's reported that Barclays have around 600 million invested into that business. So let's step back and look at the bigger picture. This isn't one problem. This is borrower stress, lender collapse, funding withdrawal, record fund redemptions, and liquidity restrictions across different countries, different industries, across different parts of the credit ecosystem. That's not random, that's a pattern. Now let's be clear, this is not the global financial crisis of 2008. The banking system is better capitalized, leverage structures are different, and regulation is stronger than it was back then. But that doesn't make this irrelevant, because what we are seeing now is something that credit markets always reveal first: fragility. When markets are strong, weaknesses stay hidden. When liquidity tightens and confidence shifts, those weaknesses surface, and recently they are surfacing more often. A borrower fails, a lender collapses, funding is pulled, investors rush for liquidity. Individually manageable, collectively concerning. The speed at which private credit has grown over the past decade means that even a modest shift in sentiment can have outsized effects. If redemptions accelerate, if defaults continue to rise, if funds are forced to sell assets into weaker markets, then what begins as contained stress can evolve into broader instability. We're not there yet, but the frequency of warning signs is increasing. And in credit markets, when warning signs appear regularly rather than randomly, that's when you start paying close attention, because credit doesn't break loudly at first. It cracks quietly, and those cracks are now visible. So hopefully you've enjoyed today's video, you found it useful, informative, most importantly, thought-provoking. This is obviously a developing story, and I'll continue to monitor how the private credit markets evolve over the coming weeks. If you found this video useful, then please give me a thumbs up, because it really helps the channel. And if you haven't subscribed yet, then please do so. Don't forget that I'm currently running my competition where you can win my property or a cash alternative prize. Please scan the QR code on the screen now, or click the link in the description below if you're interested in funding the channel and getting involved in that. Thank you also to everyone that supported me in other ways. If you've bought me a coffee or sent me a YouTube super thanks, thank you so much for that. And if you've signed up as a patron or a member, I really appreciate that long-term support. And here's something to put a smile on your face.
Give you your card.
Thank you.
She'll give you your receipt.
Thank you.
She'll give you one to sign.
Thank you.
She'll give you your package.
Thank you.
She'll give you your pen.
Thank you.
Mm-hmm. Thank you so much. No, she gets everything here.
Okay.
That
Well,
way you
thank
know
you
she
so
didn't stick
much.
somebody anything anywhere else.